Okay, good afternoon. Welcome to today's webinar, Introducing Passive Pure Model Portfolios. This is Catherine Barr. I'm the Director of Communications at New Capital. Before I get started, I have to offer the following disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Now, before I pass the controls over to Leonard, I am going to start a quick survey. If you will take a few moments and answer this survey.
Okay, hello everybody. I made this questionnaire here. I figured it wouldn't be so simple to answer it quickly or immediately, but I did want to see what everybody thinks about these questions and sort of the depth of knowledge of our clients and a lot of these things we've talked about. The first question, what is the most important thing to you about an investment portfolio? There's no right answer here, but I just wanted to see what comes to the top of mind for each of you. The second question, which of these factors has since 1930 resulted in higher long-term portfolio growth? There is a correct answer to this one. And I just wanted to see what everybody says. Is it value or is it growth? Number three, which of these factors since 1930 resulted in higher long-term portfolio growth? Small company factor or the large company factor? And number four, recent relative performance, so let's say over the last 5 years by value stocks, so that's relative to the market or relative to growth stocks, has been low or high. And what about international stocks? Relative performance over the last 5 years. So those are the 5 questions. And I'm asking these because we're going to touch on these in the presentation today. So, all right, Catherine, are we ready to?
We've got eight people.
Okay, 8 people, and some of you may be annoyed and like get on with it, but we always try to start the show with a survey to get you into it and get it involved. So all right, let's see some results. All right, so the most important thing to most people, 5 of you picked long-term performance, 63%. 2 of you picked management fees, came in second, but a distant second at 25%. 1 of you picked short-term performance. None of you picked composition. All right, and again, there's no right answer to that one. Different things of these are important to different people, and there is no right answer. But I sort of expected that long-term performance would be in the lead, and it was. Number 2, which of the factors has resulted in higher long-term portfolio growth? We have trained you well. 75% got that right? I thought the way I phrased it, I was going to throw people off. But yes, the value investing since 1930 and value stocks have outperformed growth stocks by, I'd say, about 2% a year is probably the average annual outperformance of value stocks versus growth stocks. It's a paradox, right? You would think that, well, growth stocks are going to have the higher performance than value stocks because they're called growth, but it's a paradox because growth companies tend to be more highly priced, have higher PE ratios, and therefore that reduces their longer term returns. Number 3, which of the factors has resulted in higher long-term portfolio growth? Small company, again, we trained you well, 63%, 5 out of 8 got it right. Small company performance has outperformed large companies, again, by, call it a couple % a year. And that's also counterintuitive, right? You'd think, well, big companies, they're going to have higher returns than small companies that are publicly traded. But if you think about it, small companies have to deliver a higher return, have to be priced for a higher return over the long term than large companies, or nobody would buy their shares. And then recent relative performance by value stocks has been low or high. So here you got it wrong. Recent performance by value stocks has actually been lower relative to the market and relative to growth stocks. And that's had an impact on our portfolios at New Capital Management. But for reasons that Todd is going to talk about, and with reference to facts that Todd's going to talk about, we think that's a temporary thing that's likely to reverse. And also wrong on international stocks. International stocks have performed relative to U.S. stocks have been low. So 4 and 5, the majority got it wrong, the minority got it right. Value stocks have underperformed relative, and international stocks have underperformed relative. Okay, and with that, I'm going to go ahead and get my presentation started about Passive Pure and tell you all about what that's about. Now, let's see. Here it is. All right. So we are here today on this webinar, and we try to do a webinar every quarter. And sometimes we do market reviews, and we're trying to expand the topics that we cover in these webinars. And so we're going to be talking about a new set of model portfolios. You all probably know that we introduced our first set of model portfolios beginning around 2017. And we call those Passive Plus portfolios. And most of you, if not all of you, are now in a Passive Plus model portfolio. Now, the Passive Plus portfolios range anywhere from conservative, what we call Model 1, to aggressive, what we call Model 8. But they're all part of the same set of portfolios called Passive Plus. They all have things in common. And in general, these are factor portfolios. They, especially in the equity and the stock investments that we make for you, these tilt toward value, they tilt toward small cap, and lately they tilt toward something called profitability, which is the newest factor that's been discovered and proven up by the academic financial part of the profession. And so we call all that Passive Plus. The reason we call it Passive Plus is that these factors, value and small company and profitability, over the long term, we would expect to provide some outperformance versus the general broad market. And so the portfolios we tilt, with a lot of help from Dimensional Fund Advisors, the specialists in this area, tilt toward these factors, and again, we would expect some outperformance. The theory of these factors comes from the research that has been led by two men, Eugene Fama, who's a professor and a Nobel laureate at the University of Chicago, and Kenneth French, who is his colleague who teaches at Dartmouth, and both of whom are on the board and significant shareholders at Dimensional Fund Advisors. And their research is seminal and really titanic in the world of academic finance. Now, a lot of you, not most of you, when you hear about an index fund, often that refers to just a pure, although these days not so much, but traditionally it's referred to a general market index. The most well-known of these is the S&P 500, which is a United States only, large company only index. And but it is but it is not by any means representative of the entire investment universe. Now, we started to talk about a couple of years ago implementing portfolios that are pure market, broad market portfolios without factor tilts. So they wouldn't tilt toward value. They wouldn't tilt toward small cap. They wouldn't tilt toward profitability. They're basically, you're just meat and potatoes market index funds. And these are the constituents of passive pure, or rather the components. And so Todd and I have been working to assemble. Todd's done a lot of the detail work on assembling these portfolios. And we believe that these portfolios make sense for some clients. They don't necessarily make sense for all clients, but they make sense for some clients. And we will talk later in the presentation about who it might make sense for. And then ultimately, the answer is we'll have to talk to you one-on-one as to whether it applies to you. We're not just going to have you send us an email and say, give that to me, and then do it. It's going to take some conversation, and there may be some restrictions from a tax standpoint, for example, as to whether we can do it. In putting out this passive pure set of portfolios, we're trying to take advantage of the explosion of ETFs, what are exchange traded funds. These are index funds that trade publicly and on the stock exchanges during the trading day. They tend to be low cost. At Fidelity, a number of these ETF funds are no transaction fee. The most notable of these is iShares. So iShares is owned by BlackRock. They bought it several years ago from Barclays, which invented the iShares. And right after the financial crisis, you may remember in 2008, Barclays had some bad problems in the financial crisis. BlackRock is now maybe the largest asset manager in the world, I think, but certainly up there in the top three. And they bought, they bought the iShares family of funds from Barclays. And so BlackRock, Vanguard, and I think State Street are the top three providers of ETFs. The fees are very low, and iShares has an agreement with Fidelity for a number of their funds to trade without any transaction fee. Now, that means that BlackRock is paying Fidelity, I guess you'd call it, a revenue sharing agreement. So that's built into the thing. But when we trade these funds, there's no transaction fee associated with them. And you probably know that when we trade the DFA funds, there's right now, we've gotten it down as far as we can, a $15 transaction fee, but it's still a transaction fee. We don't do a ton of trading in the passive plus portfolios as a result. And I frankly, personally hold the passive plus portfolios, and the whatever, $50 to trade doesn't bother me, but it may bother you. So we will be offering you in the passive pure no transaction fees. And then another reason is that there have been recent concerns by some clients, not by most by any means, but by some, over tracking error. What is tracking error? Well, tracking error is a variance between a portfolio and its benchmark. So if you put together your own portfolio, let's say of large company US funds, and you want to see how does it compare, you would probably compare it to the S&P 500. And the difference in performance between your portfolio and the S&P 500 would be the tracking error. How closely does your portfolio track the S&P 500? So it could track exactly, highly unlikely. You could have outperformance, so the positive tracking error, or your portfolio might underperform the S&P 500. The vast majority of active managers, professionals, believe it or not, 80% of them underperform the S&P 500 after fees are taken into account. which has led lots of people to say, well, I may as well hold the market. And so that's what Passive Pure represents, basically holding an investment in the market. So if you decide, well, I don't like tracking error, I don't want tracking error, Passive Pure would be something we would discuss with you. Now, so there are trade-offs between Passive Plus and Passive Pure. Passive Plus on the left, which is what clients hold for portfolios right now because that's all we've offered. The reason it's all we've offered is because I began an affiliation back in 2008 with Dimensional, and Dimensional specializes in factor investing. And factor investing has demonstrated a consistent, credible, and logical outperformance of the broad market over long term. So that's bullet point number. Let me see if I can do some annotation here. Those of you who are on the last one, I think you may remember I had sort of difficulty figuring out how the writing thing works. I hope I get it better today. So factor tilts, right? And then a higher expected long-term performance versus the market would be something that we would expect from Passive Plus, but we can't guarantee it. The value premium in the future could become a value tax. I don't expect that to happen. The most credible and highly credentialed finance academics in the world don't expect that to happen, but it could happen. We don't know the future. Passive Plus, the portfolios we put together for you, are tax efficient. The turnover, for example, in the Passive Plus equity funds is very low. And I think most people experience low regular capital gains taxes from the Passive Plus portfolios that we provide. They're inexpensive, around 30 or 40 basis points for the entire portfolio, which is low. And we do tend to use more active management on the fixed income side, and so our bond portfolios are actually a bit more expensive than the equity portfolios, and greater tracking error, there it is, versus the benchmark, again because of these factor tilts, right? So if we get a period where small cap and value and profitability are underperforming versus big, right, and growth and whatever junk, sorry for my handwriting, and we're in a period, if we're ever in a period where big junky growth is in vogue, then we may underperform and have greater tracking error. Well, guess what? When is a period where big junky growth is outperforming? Right now. All right? So if that bothers you, that big junky growth is outperforming right now, well, the answer might be Passive Pure. So Passive Pure is pure market cap weighted exposure. A company is represented in the index and in the portfolio by its market value, and it is rebalanced in the portfolio based upon its market value and solely its market value. There's no other factor that goes into it being in the portfolio, not it being small or being a value or profitable, just its value, and nothing wrong with that. That's pure market efficiency exposure. We expect the performance to very, very closely approximate the long-term broad market performance, and short-term too, frankly. We would expect short-term performance to also be very similar to the market. While the Passive Plus is tax efficient, these tend to be even more tax efficient. They tend to have even lower turnover than the Passive Plus portfolios. Whereas the Passive Plus portfolio is inexpensive, the Passive Pure portfolio is dirt cheap. Todd's going to tell you how dirt cheap it is when we get to his slides, but it is dirt cheap. And then lower variation, lower tracking error versus the benchmarks, right? So if you are someone who, when you get your quarterly performance reports and you do not like to see, and frankly, over the last year, we have had a substantial amount of tracking error versus our benchmark over the last year, not over the last 5 years. I don't think over the last 3 years, and not over the last 10 years, but over the last 1 year. If that is driving you nuts to look at your quarterly report and see that we have a divergence between the benchmark that we're giving you And there's nothing sacrosanct about the benchmark. It is a Morningstar benchmark. It tends to be close to the overall market weight. But if you cannot stand to see any tracking error versus a benchmark, then we would have a conversation. Okay, so I'm going to turn it over to Todd now to talk about some more details and historical performance and annual returns of the Passive Plus, Passive Pure, and I think he's going to throw in the S&P 500 for a point of comparison as well. So give us just a second here. I've got to turn off my computer and sharing, and Todd's going to turn on his.
Okay. Can everyone hear me okay? Hopefully you can. So thank you, Leonard. So I think that was a pretty good introduction of kind of how the model portfolios have evolved to this point. And so this is something that, Leonard and I actually we've talked about these portfolios for the better part of the last couple of years, and always thought that this may be in addition to the model suite of options that we offer to clients. But the foundation of our investment philosophy really is grounded in long-term performance, and we believe the DFA story and believe the empirical data that supports that will continue on. There's really nothing that, even over the last year or so, and the divergence we've seen between value and in some regard small cap stocks and even the U.S. versus international, has given us any reason to think that has changed. And so this screen here, this first slide I want to show is just really an illustration of the performance between what the Passive Plus equity allocation would have done, looking backwards over the last roughly 20 years, as well as the S&P 500 and what we would call the Passive Pure portfolio, which would be the more index-based portfolio. And we used some proxies here to just estimate those returns. And so the first line here, you'll see this big line on the top, that's a Passive Plus proxy. And what we use there is a dimensional equity balance strategy. And so that's just an equity strategy that Dimensional provides, or an index they provide, that's representative of the world market. It has emerging market stocks, it has US stocks, it has international stocks, it has real estate, and it has more value and small cap tilts, much like we would see in our Passive Plus portfolios. It's not exactly the same portfolio that you'd have in your portfolio in the Passive Plus models, and that's mainly because the DFA equity balance strategy actually has a higher weight to U.S. stocks, about a 20% higher weight to U.S. stocks than we would see in the world index. And the index that we use, the benchmarks we use for Passive Plus, and really for the Passive Pure portfolio going forward, is an index that's 95% of the MSCI World and 5% of the Dow Jones U.S. Select REIT Index. So really, it's 95% world equities and 5% real estate investment trusts. And so that weighting of the MSCI World is actually the true market weight. So it's about 50% in the U.S. stocks, about 30% or 35% in developed international stocks, and about 15% or so in emerging markets. And so looking at this chart, you can see here that obviously it's pretty easy to see that the performance of the dimensional equity balance strategy, where we're saying the Passive Plus proxy, has done extremely well. And so $1 invested back in 1999 has grown to roughly $6.09 over that 20-year period. Below that, you'll see the S&P and the Passive Plus proxy pure, the Passive Pure proxy have actually tracked each other pretty closely. And up until this point here, the MSCI World and a 5% REIT index actually had outperformed the U.S. For going back to 1999. It wasn't really until this period here, which is a lot of the discussions that we're having, and Leonard had alluded to earlier, where we saw the U.S. really outperform the rest of the world, and we're starting to see a much more of a divergence. So what that has caused in the Passive Plus portfolios is that not only has value not worked and small cap not worked, but international hasn't worked as well. And so that has created probably more tracking or more variance to the benchmarks than we would have anticipated had we had known, going back probably 3 or 4 years. And so it's interesting that there's a lot of a lot of academics now looking at this phenomenon, and there's a lot of studies and a lot of information that actually show that even if you go back further on this graph and you look at the difference between the S&P 500 and, let's say, the MSCI World, the majority of outperformance that's happened between the world and the U.S. really has happened in this period. So this is really an extraordinary period for U.S. stocks to outperform international stocks. And as investors, contrarian investors and the like, look at this, we look at this as this is likely to not continue into the future. That performance like this, it's extraordinary, that is atypical and really doesn't have a whole lot of explanation from the fundamentals. I mean, there are technical reasons why we can say this happened. A lot of it has to do with extraordinary monetary policy and the like that we've seen since the financial crisis. But nonetheless, our belief is that this will not continue to persist in the future, and that international stocks will close the gap at some point here and do much better.
Not likely.
Not likely, exactly. I should say not likely. Okay, so moving on. So if we actually look at this performance in aggregate, and here you can just see some annualized return numbers to those lines that we just showed you a minute ago. And the passive plus proxy here, going back over the last 20 years, averaged 9.37% return. The passive pure proxy, about a 5.35%, and this is versus the S&P at 6.14. And again, the growth of the dollar values are the same that we saw before. No surprise there that this has actually been the better strategy of the 20-year period. However, when you look at volatility, you can see that volatility actually is not in the same direction. And you can see that the equity balance strategy actually took on more risk. And if I go back actually to this slide, you can kind of see that in the picture here. And you can see that this line here has had much higher peaks and valleys than we did see through the S&P or the proxy for the passive pure portfolio. And so again, this is something I think that has scared some investors as well, is that the volatility has been higher than we have seen in U.S. stocks in particular. And a lot of us will compare our portfolios and look to see how our portfolios are doing to what the U.S. markets are doing. And the S&P 500, as Leonard had said earlier, is probably one of the most well-known market indexes in the world, and is often referred to as what the market is doing and what stocks are doing. And you can see here that over this 20-year period, the S&P 500 actually had lower risk than some of the other investments, and definitely lower risk, I think, than some of your portfolios. But not by much, exactly. And again, just to reiterate, we're just talking about the equity portions of your portfolios. This does not include the bond pieces, because the bond pieces, as Leonard said, are the passive plus, the value premium, the small cap premium, the profitability tilts. Those are all happening within the equity sleeve. So we are comparing just the equity piece of the portfolio. So if we break it down and actually look at the annualized returns over a couple different periods, the first thing that jumps out is, again, no surprise, over last year, the S&P 500 is up 4.68% versus either the passive plus proxy or the passive pure proxy, being very close, but strong performance of U.S. stocks. And the fact that the passive plus proxy and passive pure proxy both have a substantial amount of international exposure, that has been a drag in performance. There's no question about it over the last year. And that continues on actually as you work through the numbers here, and actually going back even further, you can see that the U.S. performance has distorted the relative performance of the portfolios. Things have changed a bit here, though, year to date, and you can see this here, that actually the passive plus proxy is outperforming the S&P 500. And why is that? Really, it's because mid-cap stocks and smaller cap stocks have actually done relatively well here in the first part of 2019. And so so that's something that is encouraging, and hopefully it's maybe I don't want to say regime change, but a change in investor sentiment to smaller cap companies. But there's no question that small cap has been very additive to performance of the passive plus portfolios for the year to date. So when we talk about these portfolios and we talk about our philosophy, and there's a reason why our initial model portfolios were the passive plus portfolios, and that's because we're trying to play a game where we want to put the odds and the highest probability of success in our favor. And so what the next few charts will start to show us is what's the difference if you were to choose between the passive plus portfolio and the passive pure portfolio, the likelihood that in any given year you would see better performance in one portfolio versus the other. And so what this is showing is actually going back over the last 20 years, it's looking at 20-year periods of using monthly observations of annualized returns between the different two portfolios. And the portfolios in blue, those are where the passive plus portfolio outperformed the passive pure portfolio. But in any given year, it doesn't always happen. And you can see that actually passive pure outperformed passive plus in these periods here. And if you break it down over the entire study, you can see that it's about 80% of the time passive plus will outperform passive pure. About 22% of the time passive pure will outperform passive plus. As we start to extend the time frame and we look out 5 years, so now this is looking at 5-year rolling returns, you can start to see the difference get amplified. And now passive plus outperforms 97% of the 5-year periods, where passive pure outperforms only about 3% of the time. And so this is just saying that there's only, in this study here, 1, 2, 3, 4, 5 year rolling periods. So five periods of consecutive 5-year returns where passive plus would have outperformed a passive pure strategy. And then lastly is a 10-year rolling period. So this is looking out even further. And this is pretty compelling for the passive pure portfolio, the passive plus portfolio, in that there are no rolling 10-year periods where the passive pure portfolio outperformed passive plus. And so this is because the value, small cap, and profitability outperformed consistently over this period. And so therefore it provided enough of a return driver to give you better positive returns or stronger performance over a more passive or market-based strategy. And so if we look at the two portfolios, and this is just a comparison of what these portfolios will look like from some of the metrics that Leonard had talked to early on. So passive plus, we said it has a higher tracking error. What's that? What is that? What has that looked like? Well, going back, looking at the portfolios that we've been managing for across the practice, the tracking error has come in roughly around 2%, and we'd expect it to be right around that number. So plus or minus 2% of the benchmark in any given year. The expense ratio, the cost of these portfolios. Now this is across the entire range from the most conservative to the most aggressive. The expense ratio is roughly 40 basis points. That's the average. The transaction cost that Leonard had talked about $15 per trade. And that is for those of you who don't know, that's the DFA funds have a transaction cost associated with them. I believe PIMCO has a transaction cost associated with them. And any Vanguard funds we have those trade costs. And the others we use right now don't have trade costs, but there may be others that we may implement in the future that could. But the good thing is that we've negotiated down with Fidelity to a minimum of $15 per trade on these transactions. And then the last thing is a tax impact. So as Leonard had alluded to when he first started talking about passive plus, that they were tax efficient, and they are. And so this is relatively low for the rest of the industry, and definitely much lower than you'd find in a more active portfolio. And this is what this tax impact measures. Is it measures on average your performance is decreased by about 0.72% because of taxes in each year. And that's just an average of the different funds in the portfolio that we use. So it's a weighted average that's provided by Morningstar. They actually calculate called the tax ratio. And so, but that's pretty good actually. 0.72 is actually on the lower end that you would find. looking at passive pure, we address some of these larger these larger numbers. So the first thing is the tracking error. We anticipate the tracking error should be closer to 0.5%. So much tighter to the benchmarks that we're using, much closer to realizing the market returns, if you will. Expense ratio. This is, again, the weighted average expense ratio across all portfolios is just about 0.08%. And so I think the high may be 0.12%, and the lowest is like I think it's 0.6, 0.5. And again, that just depends on the portfolio, the mix of stocks and bonds you have in the portfolio. But on average, it's about 8%, 0.08%. Transaction costs. Leonard already addressed this. $0 per trade. And so this is something that we can do with Fidelity relatively easy. And Fidelity has joined up or really aligned themselves with BlackRock and iShares, as well as some other providers, to provide zero transaction fee trades. So there's no commission to buy or sell any of these instruments that we use to implement the portfolio. So that also minimizes your cost as well. And then lastly, the tax impact, using the same methodology we did on the Passive Plus. We calculated that, and you can see the tax impact is much less, about 0.2%. Again, what that's illustrating is that we expect that in any given year, the tax impact of the portfolio should decrease your returns by roughly 0.5%, based on the metric provided by Morningstar. And so with that, I will turn it over to Leonard to finish it up.
Todd, thanks very much for giving us details around Passive Pure. And I'm sure a number of you, the first question is, why the hell would I want a portfolio if $1 grew to $6 over the last 20 years? Why the hell would I want a portfolio that grew from $1 to $3 or thereabouts? Half the growth. Who the hell would make that choice? And that's the reason I asked the question in the survey, what is the most important component, or most important thing about a portfolio? And I think 75% or whatever, 6 out of 8 who answered the question said long-term performance. Well, that's good, because that's really what the Passive Plus portfolios are focused on, is superior long-term performance. That's what we've been all about. But 2 of you said we're interested in the lowest costs. And we don't want to ignore that issue. We don't want to say, well, we don't want you as a client. Go somewhere else. There's no point. We're agnostic regarding those questions. If what's important to you is long-term outperformance or the chance of it, because again, we can't guarantee it. All we can do is follow the best science that we know to be able to provide that. That's Passive Plus. If some of you say, I want the lowest cost and I don't want any tracking error, and I just want my reports to show that I'm tracking with the benchmark, well, that's Passive Pure. So who's a candidate for the Passive Pure portfolio? Well, if you have predominantly tax-deferred accounts with us, so if the vast majority of your money is held in IRAs or some other tax-deferred type account, you would be a good candidate. And the reason for that is that we could sell you out of the Passive Plus portfolio and put you into the Passive Pure portfolio without there being any tax effect. But if you have large amounts of capital gains that are built into a taxable account, it's probably not going to be worth it to pay a bunch of taxes to be able to move from Passive Plus to Passive Pure. All right, so, predominantly tax-deferred accounts. If, again, the bottom line cost is the most important thing to you, well, it's awfully hard to beat, what Todd showed you, 8 basis points. That's dirt cheap. And so if that's compelling to you and you say, I just want the cheapest portfolio I can possibly get, well, then you would be a candidate for Passive Pure. You just have to decide that you're going to part with the idea that there's going to be any kind of long-term outperformance of the benchmark. All right, because it's not going to happen. So, and if tracking error bugs you, so if the 4% return on the S&P 500 over the last year versus the 40 basis point, let me say it again. If the 400 basis point outperformance over the last year of the S&P 500 is driving you nuts, and you feel like, these guys don't know what they're doing, then which is to say, the tracking error is bothering you, then we would want to talk with you about Passive Pure, because that's going to just take that issue and get rid of it. Okay, next is, implementation. How would we implement Passive Pure if it was something that we both decided together that we were going to do? Well, we right now cannot do both Passive Pure and Passive Plus. You have to choose one or the other. And the reason for that is because our rebalancing software provided to us by Morningstar, we are rebalancing your accounts at a household, not an account level. And the reason we're doing that is to make sure that we arrange your accounts in the most tax efficient way. And the only way to do that is for you to have the same model implemented across all of your accounts. Now, it may be that in the future we'll be able to do one and the other, but right now the software is not set up to be able to do that. But we'll continue to explore that and see what's possible. But we don't want to create problems or headaches, and so you would have to choose Passive Pure or Passive Plus right now. I talked again about I talked earlier just a second ago about capital gains tax considerations. So if you say, I'm interested in Passive Pure, we would immediately proceed to a discussion about what sort of capital gains you would face in switching out of Plus to go to Pure. We would have to run some numbers on that, and we might conclude, no, it's no problem, or we might conclude, no way. Rebalancing frequency. We expect that Pure is going to be rebalanced more frequently because we don't have transaction costs. So if that's of interest to you, and also to minimize the tracking error. So since there's no transaction cost for us to execute the trade, and we can do it quarterly, then there would be less chance that tracking error would open up over the short term during the course of a year. And so we would expect that we're going to be doing probably a quarterly rebalancing. So if that was of interest, we would, to implement it, have to have individual discussions with you. We're not just going to get an email and do it. It's going to take more intensive discussion to make sure that we cover all the bases, because we don't want someone to get something that they think they want, but they didn't really want. So we want to make sure that that's the case. So analysis, and then rollout date for implementing the portfolio. I would guess the first Passive Pure portfolios, if we got there with any clients, is probably I don't know. We're in April now. Might be sometime in June, July period, something like that. Todd's nodding, so I'm not saying anything that he disagrees with. And I think we are now ready for any questions, and I think we've already had some questions that have come in.
Okay.
Catherine's going to take questions.
So one question came in specifically from your presentation, Leonard. How would you define big junky growth from earlier?
Yeah. Big junky growth means that big companies, growth companies, and companies that where their profitability may not be and cash flow may not be so established are in vogue. And so often that means, tech type of companies, right? Tech companies where everyone's betting that they're going to continue to grow very rapidly. It doesn't mean they're bad companies or that the management's bad. When I say junky, we tend to mean that there just aren't the profits or cash flows there right now to support the valuations of the companies. And so they tend to trade at very high valuations. So that's what I mean by big junky growth. And we've been in a period when, people can't get enough of Netflix and they can't get enough of Facebook. And to us, it looks a bit like 1999 when people couldn't get enough of Dell, and they couldn't get enough of Cisco Systems, and they couldn't get enough of WorldCom, and they couldn't get enough of Enron, and you know the rest. And Warren Buffett was washed up and had gone from the greatest investor of all time to the worst investor of all time. And then, of course, we had the tech crash. So 1999 was a year, and 97, 98, 99, when big junky growth was in, but then it was way, way out. So that's big junky growth. Okay, next question. And by the way, your portfolios have some big junky growth. I want to make this clear. It's not that your portfolio has zero big junky growth. We make blended, diversified portfolios for you. So it's just that we underweight big junky growth in your portfolio rather than market weighted or overweighted.
Okay. Is Passive Plus sort of like the couch potato fund Scott Burns used to write about? Is the next question.
Passive Pure is, yes, more like a couch potato approach. Yes, I would agree with that. By the way, Scott Burns runs a company out of Dallas, and they've got a web offering, writes a column. And Scott Burns pursues a strategy in association also with Dimensional Fund Advisors and DFA. I know that because I've sat next to him at a number of conferences at DFA. So I think that that what they are actually implementing at his company is more of a passive plus portfolio. However, in his writings in the press, I know he's got a column, what he's talking about is probably more like a passive pure portfolio. And so, yes, I would say our pure is more like a couch potato. I don't really love that term, more of a couch potato portfolio, but it's not an exact analogy, but I guess I could sort of go along with that a little bit.
Okay, the second two, or the remaining two questions so far, please feel free to continue asking questions. The second two questions are the same. How do your management fees differ between Passive Pure and Passive Plus? And the second question is, what are the ranges for Passive Plus, for Passive Pure?
That's a great question. Our fee does not change. And in fact, just to be perfectly blunt, we run a survey every year, and we recently got the results. I would invite everybody to look at the results of our survey. And we ask a question about our fees. And every single year, the by far largest answer that's come back is that our fees are just right. And so our fee does not change for Passive Pure. We still have to go through the same work and the same evaluation. Todd's had to go through and do all sorts of due diligence on the funds. We expect that we're going to rebalance actually more frequently. So Passive Pure is going to put more workload on us from that perspective. We do have some clients who occasionally come to us and say, they like a discounter, they don't want to pay the fee. Very often there's no rationale to that request. They just want it cheaper. And over the years, I've become more and more resistant to the point of absolutely not negotiating to lower our fees, because what we do very, very well, and we do it at a very, very fair price. But when I get that question of if we can lower our fee, what I'm probably going to say is, I think you're a candidate for Passive Pure. Because what I'm going to say is, if you want a cheaper portfolio, we will get you a cheaper portfolio. It's just not going to come out of New Capital's hide. It's going to come out of the portfolio manager's hide. So if you want a cheaper portfolio, we can immediately cut your portfolio by 30 basis points, and we'll be happy to do that. But it's not coming out of us. We run a lean and efficient operation. We charge a very fair price, but we can lower your portfolio costs by 30 basis points, close to the blink of an eye, excluding the issue of taxes, which we would need to talk about. And that may be compelling to you, but you will have to accept that the long-term outperformance of your portfolio is likely to be lower than it would be under Passive plus. I can't guarantee that by any means, but that's my expectation. And that would be the expectation of any financial professional worth their salt in this business. So if you're willing to part with, and Todd showed you that the return of $1 was double that for Passive Plus. So you can cut your portfolio costs. It's not going to be our costs. It's going to be the cost of the portfolio. But you may pay for it, more than what you cut it by in the performance. Can't say that, but that may be something that you want to do. Hope that answers the question. Todd, did you want to add something to that?
Just on the range of fees.
The range of fees. Okay. Yeah.
Okay, so to address the question, just in regard to what the range of fees are between the two model portfolios, in Passive Plus, the cheapest portfolio is 0.3%, and the most expensive portfolio is 0.47. Within Passive Pure, the cheapest portfolio is 0.063, and the most expensive is 0.096. That's how it works out. And just to add, the tax efficiency of the portfolio is opposite. So I can give you those numbers as well. In Passive Plus, the portfolio that had a management fee of 0.47 actually is the most tax efficient of those portfolios at 0.59. And the cheapest one at 0.3 management fee had a tax efficiency of 0.85. And you'll see the same dynamic in Passive Pure. The cheapest portfolio at 0.063% had a tax efficiency of 0.66, and the most expensive at 0.096% management fee had a tax efficiency of 0.43.
The others? I'm just going to give a little summation. Okay, everybody. Well, thank you very much. I'm going to turn it back to Catherine in just a second to close it up. If you are interested in a Passive Pure portfolio or just discussing it, please feel free to contact either me or Todd. I think Todd's probably the first best point of contact because he's going to have to engineer it for you. But feel free to contact either one of us. Either one of us can discuss initially and in depth whether it makes any sense. And we will undertake an analysis for you. I hope the presentation, even if you've concluded already that you're not interested in Passive Pure, I hope the presentation has been interesting and of value to you, just to re-educate and re-emphasize to you why we have you in the portfolio that we do in Passive Plus, and give you just yet again a chance to get some grounding in investment theory and investment facts. We always value the opportunity to do that, and we appreciate all of you being on the call today to at least do that. And I'm going to turn it back to Catherine to wrap us up.
Okay, great. Thank you, Leonard. And thanks again for everyone for being on the webinar today. If you have any questions, again, like as Leonard said about the content of the portfolios, Todd or Leonard, and if there's any other questions, please feel free to call any of us. Again, thank you. I hope everyone gets outside and enjoys the gorgeous weather this afternoon. And everyone have a lovely rest of your day. Thanks so much. Bye-bye.